This is all right. I need to first make a statement that last week I made a video that I didn't post. But my bias has completely changed. I'm a little sick, so this part of the video is going to be really brief. Um Last week I spoke about the outperformance between the Dow versus the Nasdaq. This was before the Fed announced that they would be um cutting by 50 basis points, which was somewhat forecasted, but it was the potential for 25 basis points to 50 basis points. So the Fed is really eager to get the economy moving again. Um, I'm uncertain if they're going to cut again, but if you want to watch the rest of the video, it'll kind of show how my bias went from being to the Dow to where now my bias is in towards the Nasdaq. And also my bias last week was I'm sorry, I'm trying to stop from coughing. My bias last week was playing volatility rather than having a super bullish or bearish bias, but now I do have more of a bullish bias on the indices. I also have a bullish bias on the Kiwi, New Zealand pairs, the pound pairs, and the Aussie pairs. They've just been going from strength to weakness. The pairs that I have been bearish have been the USD, the CAD, and there's another. Oh, the yen. Um, and as you can see, with my relative strength index, well, this isn't the regular relative strength index, but my relative strength meter. It kind of just shows like I said, I didn't say the Swiss, I said the CAD. I have also been short Swiss and Euro. Um, Actually, Euro New Zealand and Pound New Zealand. Not Pound New Zealand. No, Pound New Zealand was a short as well. But as you can see, this has been a beautiful short lately, the past few days. I kind of just want to show the difference in how my bias has changed from technically week to week, day to day. It just depends on the data that comes out and what I'm seeing technically on the charts. I did get hit a good bit yesterday. Um, we'll just go to a smaller time frame. As you can see, yesterday on Monday, we were just sideways all day for the most part. Sunday, I don't really trade Sundays. I tried to get a little. I think I got in somewhere up here. Just got a quick move, but as you can see, Monday was just a chop. I had some longs in here this morning, and then I had some long. Well, if we go down to 1 minute chart, I had some longs here today. So that being said, I'm gonna end it there for the video. And if you want to stay for my biases from last week and my opinions, I think that the regime shift and how investors are approaching the markets is to go from a defensive portfolio into a more aggressive portfolio. So like things like consumer staples, not consumer staples, consumer discretionary is going to be a little bit more bullish than consumer staples. But anyways, I hope you guys enjoy the video. Peace. Okay, so what we're going to do today is have a different approach to how I do these videos. I have some bulletin points that I want to hit on. So if you hear me pause, I'm reading one of the bulletin points. That way I don't go off track and go on a rant about something that has nothing to even do with the video. So as you can see, today's title is NASDAQ versus the Dow, why tech giants are falling behind consumer staples. This is also going to be a little bit of analysis on some equities. So that being said, the equities that I'm going to be following up on today are going to be Coca-Cola, Walmart as the consumer staples for the US 30 or the Dow, and Nvidia and Tesla for the underlying equities for the NASDAQ or the NAS 100. So the Dow is the barter market or industrials. and the NASDAQ is heavily focused on tech. As you can see, we still have a little bit of chop in the US 30 or the Dow, but we had a more broader chop since mid-July on the NASDAQ. The underlying assets that I want to show that have underperformed are Tesla and Nvidia. And the reason why I'm choosing these two are just because these are the ones that pretty much everybody's been talking about. And I want to show that the narrative isn't always the best to find alpha and outperform the market. So that being said, the focus is going to be on Coca-Cola. As you can see, you would have done amazing if you've just been bullish since all the way like late April, early May. And then also Walmart. There's a lot of different reasons why these could be outperforming tech. But oops, I didn't want to click on that. I wanted to. Where is the you know what? Deontay just gonna have to cut that part out. Where is the thingamajig? Oh, here it is. I forgot that I had to move it like that. All right. So, oh, darn it. Okay, here we go. Why is it moving so weird? Okay, pretty much all I wanted to talk about was the reason why you'll see a lot more investors go into consumer staples versus tech. Oh, here we go. The dividend yield is because these equities have dividends. So Walmart has a dividend of 1%. And the reason why you're going to see it only has a dividend of 1% versus like a higher dividend is just because we're in an uptrend. So, you know, let's just say if we were down here, you might have a dividend of like 1.5% or something like that. I don't know. I'll have to calculate that to figure that out. And I don't have the time to do that in this video. And the other one, what were we looking at? Oh yeah, Coca-Cola. So Coca-Cola, see what the dividend for Coke is. It's going to be low as well, just because of the fact that price has moved up. Here we go. So a dividend of 2.62%. That's good. If I had to choose, I would definitely choose Coke over Walmart. Now I would choose that if I was looking for a dividend. If I was looking to trade it, I would be willing to trade either one. But when you see a rotation from tech to consumer staples, you know, you're looking for equities that are going to provide you a dividend and more secured returns. Like even if you look at bonds, I think like there's an article recently with Warren Buffett. Oh man, I'm already going off topic, but let's just bring it up. Warren Buffett, bonds. Oh, I think I missed a T in his name. Yeah, this is a recent one. Yeah, so he hasn't been a fan of bonds for a long time. When interest rates are low, there's like there are people who still trade bonds, but they're not the most ideal. But recently, look at this, $235 billion in T-bills is crazy. And there was like one article I saw where it said that he owned more T-bills than the Fed, which is crazy to even think about. And it's crazy also thinking about the fact that he's just been trading and investing for this long. But he is also a big fan of Coke. But anyways, let me get back to the notes. That way I don't continue to go super off track. This is also one of the reasons why you want to have diversification in your portfolio. So if you are So for myself, when it comes to investing or trading equities, I like to have just a long approach. I don't like to short equities. So like even Tesla, based off, I think I told you guys that I like to trade. Oh, okay. I like to trade when the 200 and the 34 period moving averages are aligned for me, which would be, I would look to short something like that. But when it comes to equities, I'd like to be long only. So, I mean, there's only so far you can go. You could go down. And I don't like to give myself the headache of trying to be short. At least when it comes to buying equities, I wouldn't mind shorting like if in an option or something like that, like buying puts or whatever. But ideally, I would just be buying calls, selling puts, and all that jazz. But anyways, why is the Nasdaq underperforming the Dow? This is not going to be something that I could put all in one video, but in my opinion, it's just because even though the Fed is supposed to cut rates, I think we have a meeting this month, this week on, is it tomorrow on Wednesday? So it's going to be very active tomorrow. I would not be looking to place any trades usually before the Fed. It can be dead. If I see something move, I might be willing to at least give it a try once or twice. But I usually try not to trade on these days. I have lost a lot of money trying to trade FOMC announcements. But it is because even though the Fed is supposed to cut rates starting this month, it's also an election year. So there's a lot of uncertainty in the market. And when there's uncertainty in the market, the thing that is always a certainty is that if you do have mandates, if you're like a hedge fund or a mutual fund or something like that, where you always have to have some type of exposure, having exposure in consumer staples or bonds is a lot safer than being heavily bullish tech. I'm not saying you can't be bullish tech, because I'm sure there are some tech equities that are doing well, but there are a lot less of them than the broader NASDAQ, which you will reflect in price. So, let's see. What else did I want to talk about? Oh, and the reasons for this could be sticky inflation. So inflation has been a lot stickier than originally speculated upon. Rates have been high for an extended period of time. And in my opinion, rates could have been, kept high or extended for a little bit longer. But at the same time, you don't want to ruin your economy. And yeah, you don't want an '08. You don't want to keep rates too high to where those people who had adjustable rate mortgages are, I know they're struggling, but it's not like they're struggling for 5 or 6 years or anything like that. And I'm not saying that's what happened in '08. I don't know if that could have been, um, I don't know. I don't know if it could have been perceived as that's what I was trying to say, but just to make sure. And then just the market sentiment, you know. This time of the year is usually pretty choppy, especially during election year. I think whoever does get elected is going to play a pivotal role in how equities will react. Um, but as traders, our focus should not be on who is elected or who wins or loses, but how we can make money. And it's not to say that we don't care about the economy, but either way, the economy is going to do what it's going to do. Whoever gets elected is going to do what they're going to do. The best thing that we can do is react and try and make money from it, because you still need to live at the end of the day. And also earning stability. Usually earnings are going to be pretty decent for these consumer staples. Like they very rarely ever miss. Very rarely will these consumer staples miss. And then also they pay a dividend. So even if you're not getting the alpha and price appreciation, you're still getting, a little bit of a kickback in the dividend. And that's kind of where I want to leave the video for today. I kind of just wanted to talk about some things that I've been thinking about writing for an article on Substack. The article will be a lot more detailed because I'm not kind of going off the cuff and just talking. I will have everything pretty structured. But hopefully you enjoyed the video. Hopefully it provided some type of insight, or just share my opinion with you guys, and maybe you'll think of something, or think of an equity that you can invest in or trade or whatever. Just a different approach. I'm not trying to give you financial advice, but I'm just trying to share my own analysis and the things that are going on in my process. For, my friends and family, for the random people that come across, and then also my future descendants if they decide that they want to learn how to trade and invest. So this is not investment advice, but this is just, I guess, your friend who just so happens to trade and invest, talking about trading and investing. So anyways, I hope you guys enjoyed the video. Please like, comment, and subscribe. And I had one question for you guys. What do you think about the current market? And are you rotating into defensive equities yourself, or are you holding strong to the bullish tech play? And what is your time horizon for your view in the market? I'm pretty flexible when it comes down to it. I don't really have a current view just based off the election. So anything past November for me is just up. Well, I guess up to November, in my opinion, it's just volatility. I don't really have a strong bias long or short. It just makes sense to me to play the volatility and just be nimble, be long and short, be open to either side. I kind of have a little bit more bias to the upside, of course, but I'm not degening. I'm not going to be a degen or degenerate into anything heavy. So that being said, my time horizon is just to be nimble until November, until after the election. After the election, I guess we'll have a little bit more of an opinion based off whoever ends up getting elected. I do think that one side will be a little bit more bullish for risk on assets versus the other one. I'm not going to say who, but however it goes, however it ends up playing out, we'll find a way to make some money one way or another. And yeah, hopefully you enjoyed the video. Peace.
Man, even Jesus had a shooter, and God be having unbelievers that didn't mess up their demeanor. And yes, they know it's hard, they know, cause when they be up in those trenches, man, they show out. But what they do